Okay, so basically the question is parent company sold inventory for 100,000 to subsidiary, it cost 50,000, year-end a quarter of stock is still on hand. Okay, so we got debit sales with 100,000. So the parent charged the subsidiary 100,000. Okay, what are we doing here? We've got a sale between parent and subsidiary, and we want to eliminate the effect of that sale. Why? Because the parent and the subsidiary are going to be consolidated, and we're going to treat them as though they're one company. So if we treat them as though they're one company, we need to eliminate anything that transactions that take place between the two of them. So we've debited sales, we've got rid of the sale that takes place, because we know that in the books of the parent, there's going to be a sale of 100,000. So we've got to have journal adjustment entries, so adjustment entries, to eliminate that sale, and this is what we're doing here. These will fit into this worksheet. These journal entries here will fit into the worksheet under adjustment entries. The sale that's taken place will be recorded in the books of the parent, but for the group, do we want that to be recognized? The sale that's taken place between P and S? No. We don't want it to be recognized, do we? Okay? You can't have transactions happening within the company, sales within the company, within the group. Okay, so we've debited sales with 100,000. Here we've got to eliminate any unrealized profit. And what do we mean by unrealized profit? Unrealized profit is simply if you've got the parent selling to the subsidiary, both of them are within the group. So if we have a profit being made between the parent and the subsidiary, it's unrealized. Why? Because the profit hasn't taken place outside of the group. Okay. So it says that we've got 1/4 of stock still on hand at year end, which means that because the total profit was 50, being the difference between 100 sale price and cost price, okay, sale price was what the parent sold the item for. It had originally cost the parent 50. So the total unrealized profit was 50, but 3/4 has actually been sold outside of the group. So 3/4 of the profit we can realize. Okay? 1/4 of the profit we can't. Credit inventory with 50,000 times 1/4. Questions? Okay, cost of sales, what's that going to be? 37,500.
87.
87?
87.
Okay, obviously we know it's going to be 87,500 simply because it's got to be the balancing item. And assuming that is correct and that is correct. Then
put that 750.
Okay. Yeah, no problem. Yeah, that would explain that. Okay, so basically 87,500, if you want to check that, you've got to, and I'm going to actually give us more. So I'm going to put the whole worksheet up here. Okay, so we've got parent, subsidiary, adjusting entries, and then we're going to have the group. Okay. So basically, cost of sales, we're looking at cost of sales only. Parent cost of sales would be?
100.
No. 50? Yeah? Subsidiary cost of sales would be? Subsidiary cost of sales would be?
80,000.
So they bought the item for 100,000, didn't they?
But they sold it for 80.
They've sold 3/4. Therefore, their cost of sales will be 75. Make sense?
Can you repeat that again?
Okay. They bought, okay, the subsidiary purchased the item, the inventory for 100,000. Yep. It then says that at year end, 1/4 of the stock was still on hand. Okay? That means what have they sold? What percentage have they sold? 3/4. So if they purchased it for 100,000 and they've sold 3/4, that means that the value of cost of sales will be 75. Okay? Okay. For the group, what should the group cost of sales be? 50. Did you say? Like, what I would do is I'd say, okay, what have we sold outside of the group? We've sold 3/4 of the stock outside of the group. What did that stock initially cost the group? When it came into the group, what did it cost the group?
100,000, didn't it?
175. Then 375.
Okay, just remember, oopsie, I should have left that. Parent, subsidiary, right? Stock came into the group, 50,000.
37.
And 3/4 has gone out of the group. So when it came into the group, yes, it was sold to S for 100,000. But when it came in, it cost 50. So we're not looking at what's happened here.
Okay.
We're only looking at when it comes in and when it goes out of the group. That's all we recognize for the group financial statements. So we're saying 50 times 3/4 will give us
375.
37,500. Okay, 37,500. So therefore, what have we got to do here? 87,500 credit. And that's correct. We've just checked it. Okay, so happy with that? You don't have to do this. As I say, you're running out of time, you're writing a test. Put that figure in, put that figure in. If you've got time, you can check this figure. If you don't have time, put it in there. It's a balancing figure. And then if you've got time at the end, you can check it. Don't leave it blank. Put it in. You might not have time to come back and check it later. Okay. Tax expense, what's that going to be?
3,750.
So where did you get that from? You said 3,000?
750.
Okay, and how did you work that out?
It's 1/3 of the
Total
inventory.
finance times 10%.
Times 30%.
10% is come to
Unrealized profit times 30%.
3,750.
Okay, just explaining why we've decreased tax expense by that. We have decreased sales for the group by 100. We've decreased expenses for the group by 87,500. So you decrease an expense by 87, decrease the income by 100. What have you done to the profit? You've decreased the profit by the difference between those two, haven't you?
Yeah.
Which is this figure here. So just explaining why we decreased tax for the group, it's because we've decreased income by greater than the amount we've decreased expenses by, and therefore the overall effect on the profit is that we've decreased profit by 12.5, which means that we need to decrease tax by 12.5 times 30%, 3,750. It means as well that from the group's perspective, the parent subsidiary, they've paid tax, but from the group's perspective, they've recognised a profit which they shouldn't have recognised. If you look from the group's perspective, therefore, they've prepaid their tax. Remember, another word for deferred tax asset is prepayment. It's like a prepayment. Deferred tax liability is like an accrual. Okay, so that's what we've just revising, and I've done that a couple of times, but unrealized profit and closing inventory, we've gone through that quite quickly. If you need to watch this again, then obviously hopefully I'll have this up by the end of today. Hopefully it'll be a good copy, but unrealized profit and opening inventory is the next a couple of journal entries that we're going to do. So what we've just done is unrealized profit in closing inventory, and now we're going to do unrealized profit in opening inventory. In other words, if you've had a situation like this, okay, at the end of the year, and now we're going to the next year. So we're looking at the following year, okay, and we're going to have a situation where there's unrealized profit in opening inventory. Okay, so what are we going to have? Journal entry that I would put up straight away whenever you've got this. This journal entry is pretty standard when you've got opening inventory, unrealized profit in closing inventory. You've got those two journal entries. Obviously the numbers are different each time. When you've got unrealized profit in opening inventory, this is your journal entry, debit retained earnings. Okay. Okay, so debit retained earnings, I could put in brackets here opening retained earnings. Debit tax expense and credit cost of sales. You wouldn't have been able to logically think that up. So you need to know that journal entry. You need to know what you're going to debit, what you're going to credit. Obviously you then will work out the numbers. Okay, so if we've got, so what we've said here is that we've got an unrealized profit of 12.5. So the previous year our unrealized profit was 12.5, right? After tax, it was, what was it after tax? 8. Is that right? Okay. So what we're going to do is we're going to say, this is where you have to understand that whenever you've got a consolidation, you do what we call adjusting journal entries. Okay? You do adjusting journal entries. The purpose of those adjusting journal entries will be to basically end up with what we call a group figure. Okay? So group financial statements. Are you changing these figures? Are you changing these figures? So in other words, are you changing the parent figures? Are you changing the subsidiary figures? No, you're not changing those two figures. Right. So when we did this little adjustment here, we did it in order to come up with the group figures. Okay? But when we do the consolidation for next year, we once again start with parent and subsidiary figures which haven't been adjusted. Does that make sense? So these figures here for the following year are going to have all the transactions that have taken place between P&S over the last few years. Right? Okay, so what I'm going to say to you is these are the figures I'm going to fill in, and I'm going to fill these figures in like this. 12.5. This is going to be 3750. And this is going to be 8750. Okay, so what I'm saying is that this happened the previous year, so that was an unrealized profit of 12.5, tax was 3750, after tax figure was 8750. What I've said, the following year, when I'm doing the journal adjustments, I'm going to decrease opening retained earnings by a net figure of 8750. Okay? Your retained earnings is normally after tax, isn't it? Okay? So what I've done is I've said, okay, what's the net figure? And I've said, okay, what we're assuming here is that last year, so included in retained earnings, there was an unrealized profit. And it's sitting in the books of the parent subsidiary. Okay? So for the group, what we've got to do is take out that unrealized profit. And that's what I've done here. I've said, okay, what's the net unrealized profit, which was sitting in the books of the parent and subsidiary? It'll be sitting in the opening retained earnings. That's the figure there. The assumption is that the profit will be realized in the current year. So whenever you've got opening or unrealized profit in opening inventory, the assumption is that yes, you take the profit out of the opening retained earnings, but the profit is actually going to be realized in the current year. So what you're doing is you're taking it out of the opening and you're actually going to put it into the current year's group profits. The assumption is that you're selling the item outside of the group this year, or you will be selling the inventory outside of the group this year. But you're doing it in quite an indirect way. And the way that you're actually increasing the current year's group profits is that you're decreasing an expense. You're decreasing an expense. With the last year's unrealized profit, we're assuming it's going to be realized this year. And because we're assuming that, we're going to increase our tax this year.